Have you ever noticed how nobody seems to see a market crash coming, until suddenly it's all anyone can talk about? One day, everyone's making easy money, bragging about their wins, and telling you the sky's the limit. The next day, it feels like the floor drops out from under the entire economy. Your portfolio tanks, the news is all panic, and even your most confident friends start whispering, "Should we have seen this coming?" But here's the wild part. Crashes don't come out of nowhere. There are always signs. They're hiding in plain sight, ignored by most and recognized by a few. Every market crash, whether it's the Great Depression, the dot-com bust, 2008, or whatever's around the corner, follows a pattern. Actually, several patterns. If you know what to watch for, you don't have to get blindsided. You can actually prepare, protect yourself, and sometimes even come out stronger. Today, I'm going to show you exactly what always happens before a market crash and what the smartest investors do about it. I'm not talking about Wall Street PhDs or billionaire hedge fund managers. I'm talking about what real people like you and me, can actually do to turn these warning signs into opportunities, not disasters. If you stick with me all the way to the end, you'll not only recognize these signals for yourself, you'll know exactly how to build a financial strategy that isn't just safe, but can actually thrive when everyone else is panicking. And if you want to sleep soundly, knowing you're one of the few who's actually ready for the next big drop, this is the video you need. Before we dive in, if we haven't met before, I'm your buddy investor. I'm not some Wall Street big shot or mysterious guru. I'm the guy who's obsessed with helping regular people break out of financial stagnation, reach true freedom, and build real wealth. The kind that lasts, no matter what the headlines scream. For years, I've been studying not just the markets, but the stories behind the numbers. I'm here to show you what really works, and to be the friend who's got your back when things get confusing or scary. And hey, if you want honest, no BS, practical guidance on investing and building financial independence, make sure you hit that subscribe button right now. It's the best way to keep yourself on track, and trust me, around here we don't just talk about getting rich, we talk about staying rich. So why does this topic matter? Why should you care about what always happens before a market crash? Because unless you're planning to live in a cave with no internet or credit card, the ups and downs of the market will affect your life. Your savings, your job, your dreams of owning a home, traveling, helping your family, maybe even retiring early, those things are all tied to the financial system. And crashes? They don't just dent portfolios, they have a way of wiping out decades of hard work for people who aren't prepared. But for those who are, downturns become the biggest wealth-building opportunities of their lives. So let's get real. Let's talk about what always happens before the market tanks, so you can stop feeling anxious and start feeling confident. The 4 patterns that always show up before a market crash. These aren't my theories. These are lessons that go all the way back to the world's first stock market crash, back when people were literally betting their houses on tulip bulbs. Seriously, we're talking 1630s Netherlands. And you'll see these patterns repeat through every crash, from the roaring 20s to the housing bubble to crypto crazes. Ready? Here's what always happens. Pattern 1. Rampant speculation and investor overconfidence. Every crash starts with a wave of excitement. People get overconfident. They stop asking, is this investment actually worth it? And start saying things like, prices can only go up. Sound familiar? That's not new, it's ancient. Let's rewind to the 1600s, to what might be the most ridiculous financial mania in history, tulip mania. Tulips, as in flowers. For a few wild years, people in the Netherlands were trading tulip bulbs as if they were gold. Not just buying them, but flipping futures contracts for tulips. Prices soared, fortunes were made, at least on paper, and pretty soon, owning rare tulips became a status symbol like wearing a Rolex today. People were betting their life savings on flowers because everyone else was getting rich. At its peak, a single tulip bulb sold for more than a year's average salary. That's like dropping $60,000 on a single plant. Here's where it gets crazy. People convinced themselves it was different this time. After all, tulips were rare, beautiful, and everyone wanted them. But as soon as reality set in, when people realized you can't eat, live in, or do much with a tulip, The bottom fell out. Prices crashed, people went bankrupt, and the Dutch economy took years to recover. It's the same story in every bubble. The Roaring '20s? People said stocks would go up forever, so they borrowed money to buy more. Dot-com boom? The internet is a new paradigm. Crypto booms, meme stocks, housing in the 2000s. Every time, the same tune. This time, it's different. Warren Buffett puts it best. The most dangerous words in investing are, "This time is different." Overconfidence. Ignoring fundamentals. Believing you can't lose. If you see this everywhere, you know the market's heating up. Pattern 2, easy money and rising debt. Speculation is dangerous enough. But when easy money gets poured on top, watch out. Every major crash is supercharged by debt. People borrow more and more to chase those rising prices. Margin loans, adjustable rate mortgages, personal loans, even credit cards. People will use any tool to not miss out. Let's take the Great Depression. The 1920s stock market was booming. But most people weren't using their own money, they were borrowing on margin, which meant you could control $100 of stock with only $10 of your own cash. As long as stocks rose, everyone made money. But when stocks started to fall, the losses were 10 times worse. People couldn't pay back their loans, brokers panicked, and the whole system unraveled. Sound distant? Remember 2008? Banks handed out mortgages to anyone who could fog a mirror, then packaged those loans into complex securities and sold them as safe. People took on debts they had no hope of paying back. When housing prices finally turned, millions lost their homes and the financial system nearly collapsed. Debt is like gasoline on a bonfire. It amplifies gains on the way up, but it also multiplies the pain when things turn south. One of my favorite stories is about Ray Dalio, billionaire hedge fund manager and author of Principles and the All-Weather Portfolio. Dalio nearly lost everything early in his career because he bet too much, used too much leverage, and got overconfident. He rebuilt his fortune only after learning the lesson. He who lives by the crystal ball will eat shattered glass. Translation? Don't bet the farm on what you think will happen. Manage risk, don't ignore it. Pattern 3. A new, poorly understood innovation takes over. Sometimes, it's not just debt and overconfidence. Sometimes, there's a new shiny thing everyone's talking about, an innovation that promises to change the game. The only problem? Almost nobody understands the risks. And that's exactly why it's dangerous. In the 1980s, Wall Street fell in love with portfolio insurance, computer programs that were supposed to protect against losses. The logic was simple. If stocks started to fall, computers would automatically sell a little, limiting the damage. But nobody thought about what would happen if everyone tried to sell at once. In 1987, that's exactly what happened. Computers triggered massive sell-offs, nobody could find buyers, and the market suffered the worst single-day drop in US history. Fast forward to 2008, and we get mortgage-backed securities, CDOs, and financial engineering so complex even the people selling them didn't really understand. The result? When housing went bust, the safe assets turned out to be built on sand. In every crash, some new innovation becomes the next big thing, until it turns out to be a ticking time bomb. Pattern 4, regulatory shortcomings or blind spots. Let's get honest. Sometimes the people in charge are asleep at the wheel. Or even worse, they're so desperate to keep the party going that they ignore the risks. Before the Great Depression, US markets were barely regulated. Anyone could sell anything. Margin debt exploded, banks took wild risks, and the government looked the other way. After the crash, we got the SEC, the FDIC, and a lot more rules. But here's the thing. Every time a new market or financial innovation shows up, it takes regulators a while to catch up. Crypto, meme stocks, new derivatives, there's always a window where people play fast and loose, and by the time rules arrive, it's usually too late. Pattern 5, warnings are everywhere, but no one listens. Before every crash, there are always warning signs. Credit spreads widen. Debt levels hit new highs. A few smart voices start raising red flags. But most people ignore them because, well, making money is fun and nobody wants the party to end. In the late stages, even people who know it's risky stick around because they don't want to miss out. As the saying goes, the market can stay irrational longer than you can stay solvent. If you're seeing all these patterns, overconfidence, rising debt, new, can't lose, innovations, lack of oversight, and a culture of ignoring warnings, it's not a matter of if the market will correct. It's just a matter of when. But here's where it gets really interesting. You might be thinking, great, so crashes are inevitable and everything is doomed. But that's not the case. The goal isn't to live in fear or to time the market perfectly, because let's be honest, nobody does that consistently. The goal is to be the kind of investor who's always prepared, so you're not wiped out when a downturn hits. So, let's talk about what smart investors actually do, step by step, to survive and even thrive through market crashes. Build a portfolio that's ready for anything. I know it's tempting to chase the hottest trend, to go all in on tech stocks or crypto or gold or whatever's blowing up this week. But ask yourself, if the music stopped tomorrow, would you be okay? Smart investors diversify, not just for variety, but for risk. You want a portfolio that works in good times and bad. That's why guys like Ray Dalio created the all-weather portfolio. It's designed to survive any environment: inflation, deflation, booms, busts. Dalio's classic formula? 30% stocks for growth, 40% long-term bonds for deflation, 15% intermediate-term bonds for stability, 7.5% gold for crisis protection, 7.5% commodities for inflation. You don't have to copy that exactly, but the point is balance. Don't let one asset, one stock, or one trend dominate your net worth. Here's a Warren Buffett trick. Whenever one investment gets so big it scares you, take some profits and rebalance. Buffett did this with his Apple stock. When it became half his portfolio, he sold enough to sleep well at night, even though he loves the company. Never, ever, ever borrow to invest in risky assets. This one is simple. Debt multiplies risk. The people who lost everything in 1929, 1987, 2008, and even in the crypto busts had one thing in common: they were using borrowed money to chase higher returns. If you need to borrow money to get rich quick, stop and ask yourself, am I really investing or just gambling with someone else's cash? Real wealth is built slow and steady. Borrowing magnifies gains, but it turns setbacks into disasters. Don't risk your future for a shot at a quick win. Watch for signs of market euphoria and get cautious when everyone's euphoric. Here's a fun test. When your Uber driver, hairdresser, or barista starts giving you hot stock tips, it's time to pay attention. When the news headlines start using words like unprecedented, record high, and can't lose, pause. Remember the dot-com bubble? Or the 2021 NFT and meme stock craze? Regular people mortgaged their houses to buy guaranteed winners. The party ended fast, and the latecomers paid the price. Smart investors don't try to time the top, but they do get cautious when the crowd goes wild. They rebalance, hold more cash, and resist FOMO. Stick to a system, dollar-cost averaging, and regular rebalancing. Want to know the not-so-secret secret of the world's most successful investors? They don't try to predict the future. They have a system. Dollar-cost averaging, putting a fixed amount into your portfolio every month, rain or shine, takes emotion out of the process. When stocks are high, you buy less. When they're low, you buy more. Over time, you win. Rebalancing is your second shield. If one asset grows too big, you sell some and add to the laggards. This buy low, sell high approach works without needing to guess the future. Focus on financial resilience, not prediction. Trying to predict the next crash is a waste of energy. Instead, ask yourself, if the market dropped 30% tomorrow, would I be forced to sell? Or would I have enough emergency cash, side income, or job security to ride it out? The biggest danger isn't the crash itself. It's having to sell at the worst possible moment. Build a cushion. Don't stretch your budget. Have enough cash to cover 3 to 6 months of expenses, or more if you're self-employed. And if you want to go further, develop multiple income streams. dividends, side hustles, rental income, whatever fits your life. That way, you're not at the mercy of any one paycheck or asset. Learn from history and make it your edge. History doesn't repeat, but it rhymes. Crashes will come and go, but the people who win are the ones who stay curious, stay humble, and keep learning. If you haven't already, check out classics like The Intelligent Investor by Benjamin Graham, Common Stocks and Uncommon Profits by Philip Fisher, and Principles by Ray Dalio. And if you want a quick read that will change how you think about money, go grab The Psychology of Money by Morgan Housel. The more you understand, the less you'll panic and the more opportunities you'll see, even when everyone else is scared. When everyone is scared, be ready to act. Here's the final twist. Every crash, no matter how scary, creates the biggest wealth transfer opportunities in history. The key is to have a plan before the panic hits. If you're diversified, have cash on hand, and aren't over-leveraged, you can buy great assets when they go on sale. That's what Warren Buffett means when he says, "Be fearful when others are greedy, and greedy when others are fearful." It's not about being reckless. It's about being ready. Let me tell you about someone you've never heard of, a regular guy named Joe. In 2008, when the world seemed to be ending, Joe kept buying shares in his boring old S&P Wink with tongue sticking out 500 index fund, month after month. Everyone else was panicking. But Joe remembered that stocks go on sale during crashes. He didn't time the bottom. He just kept buying even as his account dropped 40%. 10 years later, Joe was up 200%, while most people who sold out were still licking their wounds. You don't have to be a genius to win. You just have to have a plan and the guts to stick to it when things get tough. Now, one more thing. If you've gotten value from this so far, do yourself a favor, hit that subscribe button. Seriously, the biggest danger for most investors isn't missing out on the next hot trend. It's giving up, losing confidence, or falling for scams during hard times. This channel is your home for motivation, clarity, and strategies that actually work, especially when things get messy. And if you know someone who gets anxious every time the market drops, share this video with them. You might just save their financial future. Look, crashes aren't random. They're the natural result of human psychology. Greed, fear, optimism, and panic all mixed together. They happen when people get overconfident, borrow too much, believe in new, magic innovations, and ignore basic risk management. But you don't have to be a victim. You can be one of the few who actually sees the warning signs and uses them to build real, lasting wealth. Remember, diversify for risk, not just variety. Don't borrow to invest in risky stuff. Watch out for euphoria and hype. Stick to your system, dollar cost averaging and rebalancing. Focus on financial resilience, not prediction. Learn from history and keep growing. Be ready to buy when everyone else is scared. You'll sleep better. You'll feel calmer. And you'll be in the perfect position to turn every downturn into an opportunity. And hey, before you go, let me ask you a question. Have you ever wondered why, even after a crash, some people never seem to get ahead? Why do some folks keep falling into the same money traps over and over, while others keep building wealth year after year? If you want to make sure you never fall into the hidden pitfalls that drain your wallet, even when times are good, don't miss my next video. Avoid these 7 money traps at all costs. I'm going to break down the most common mistakes that quietly sabotage your finances and show you how to sidestep them forever. You do not want to miss it. Thanks for hanging out with me today. I'm your buddy investor, here to keep you smart, motivated, and on the path to true freedom. See you in the next one.